Hello, fellow Rebel Capitals. Hope you're well. So, my goodness gracious, Trump pulling back the tariffs a little bit. Does this mean the recession has been canceled? The stock market sure is going up. So, we've got a lot to talk about today for sure. We've got a lot to think about. There's a lot to process just daily. You guys know what I'm talking about, especially over the last 2 weeks. Every single day, just this barrage of information. And it's almost like a fire hose where you've got to just pump the brakes a little bit and say, okay, let me just focus on what really is important here and try to set aside all of the noise. So let's first go over the news as far as what Trump is doing with the tariffs, because that changes every single minute. As we know, you love Trump or hate him, but you got to admit, it's just every single day. It's, you never know what you're going to get. It's like Forrest Gump and his box of chocolates. All right. So, first thing that I saw in the news, I think this was over the weekend, is Trump pulling back tariffs to a certain degree on some of the Chinese imports. So on phones, chips, and I think it was computers was another thing. So I guess I'll set aside for a moment the economic ramifications of this, looking at it through the lens of the MAGA folks, let's say, because I found that some of them on Twitter, especially, will say that if we tariff Chinese phones, chips, and computers, then this is good. This is a great thing for XYZ reason. But if Trump has a carve out for these exact same things, well, then that's good too, because he's just playing 5D chess and we're just too stupid to understand his brilliance. And we just need to sit back and be in awe of the magnificence of whatever his end game plan is. So, bottom line, I see a little inconsistency there in the thoughts that one day the tariffs are good, but if we pull them back, then that's good too, and somehow that's not bad. But we'll go ahead and shelf that and just focus strictly on the kind of economic ramifications, considering what we've seen in the stock market and the probabilities of recession within the domestic U.S. economy. Okay, so Trump only rolled back tariffs imposed since April 2nd. So they get more into the details here with Al Jazeera. Phones and semiconductors still face heavy levies. I'm almost positive. In fact, I am positive computers were on this list. I don't know why they didn't mention that. United States President Trump has threatened new tariffs on Chinese electronic goods 3 days after the administration announced exemptions. Oh, wow. Okay. So I didn't even realize this. This is this goes back to the fire hose. So if what they're saying is true, and I'm going to go ahead and I should try to fact check them here. It sounds like Trump could be rolling back of the actual tariffs on certain goods. So I guess he could be rolling back the exemptions. Let's keep going. You got to keep track of this. The exemptions provided. Okay, so let me just get this straight here. 3 days after administration announced exemptions on smartphones, laptops, flash drives, and a host of other tech products from levies he announced on April 2nd, those exemptions provided relief to U.S. Tech companies reliant on Chinese manufacturing like Apple and NVIDIA, which saw their stocks rise considerably after the release of Friday's notice. Okay, got it. So it seems like what they're saying is on Friday, Trump came out and announced this carve out. And now on Monday, Trump is threatening new tariffs on the things that he carved out on Friday. I think that's what's going on here. Let's keep going. Then came Monday's announcement, which sparked criticism. Okay. And suggestion from his opponents and other experts that he had, in effect, withdrawn many of the steep tariffs previously imposed on China. But the latest tariffs that the Trump administration partially rolled back on Friday are only part of the most recent levies. Okay. In fact, this tense tariff tussle predates Trump. Okay, fine. Going back to Biden, we get that. I just want to know what's happening right now. So, what tariffs did the Trump administration pull back on the weekend? Are Chinese electronics still subject to U.S. tariffs? How much are they? Yes, this is what I want to know here. Please tell me quickly. What tariffs did the Trump administration waive? After dramatic back and forth, a notice issued by Customs and Border Protection on Friday listed more than a dozen product categories that would be exempted from the wave of tariffs imposed on China, specifically April 2nd. Okay. Included laptops, everything that we just said. Friday's notice specifically mentioned exemptions. Okay. We got that. Now, what happened today? Okay, this is what Trump said on Sunday, so yesterday. After criticism of Friday, or what happened Friday, Trump iterated that China was not being exempt from tariffs. Nobody is getting off the hook for the unfair trade balances and monetary tariff barriers that other countries have used against us, especially not China, which by far treats us the worst. Top officials also insist that any tariff exemptions that China electronics would only be temporary. Okay. So now it seems like we put the tariffs on, we did carve outs. Then Sunday, Trump comes out and says, or implies, even though we've done these carve outs, China's not off the hook. And then Lutnick clarifies what he meant, and that is these carve outs are just simply temporary. I don't know why do the carve outs then? I mean, let's just assume you're doing them to benefit Apple or Nvidia. Are they only going to benefit for 90 days? Or, I mean, there's no way they can kind of rejigger their supply chains within 90 days. So it's unfortunately every single time one of these press releases comes out, it's like I have more questions than I had even before reading the press release. Now but we're not just talking about, this is what I saw over the weekend, but now we're getting some insights on what could be happening with the auto part carve out, or maybe more auto part carve outs. Let's go over to the AP. Trump considers pausing his auto tariffs as the world economy endures whiplash. President Trump on Monday suggested, so that's today, he might temporarily exempt the auto industry to give car makers time to adjust to their supply chains. I'm looking at something. I mean, did he not think about this at the beginning? I don't know. Maybe it's just the 5D chess that I'm too stupid to understand. Trump told reporters gathered in the Oval Office, automakers need time to reallocate production from Canada, Mexico, and other places. And they need a little bit of time because they're going to make them here, but they need a little bit of time. Hey, you sure about that? You sure they don't need a little bit of time? Okay, let's keep going here. The statement hinted at yet another round of reversals as Trump's onslaught of import taxes. Okay, when Trump announced the 25% auto tariffs on March 27, he described them as permanent. His hard lines on trade have become increasingly blurred as he has sought to limit the possible economic and political blowback from his policies. But let's be clear. I mean, here we go. They get into it right here. Last week, after the bond sell-off pushed up interest rates on debt, Trump announced a 90-day broader tariff relief, let's just say. And this is because the bond market was blowing up. I agree with And I think that Trump is serious when he says he's really not considering the stock market, and his administration acknowledges this. I think he's being sincere, and I think that is something that we can count on him sticking to. But when it comes to the bond market, it's a completely different story. Completely different story. And because if you have the stock market go down by whatever 50%, okay, you get a balance sheet recession and you maybe get a bit of a recession. To Trump's point that he made the other day, if the bond market blows up, now all of a sudden you go from potential recession to potential economic depression. And he came right out and explicitly said he's cool with a recession, but the depression, no, not on his watch. So now that we've tried to get up to speed as far as the recent news in the tariff barrage, and then kind of, or the tariff back and forth, I guess, because one day they're on, next day they're off, the next day they're on, next day they're off. But on net, I think the market has definitely taken a sigh of relief, saying, okay, we Trump is obviously not as stubborn, let's say for lack of a better word, with these tariffs than he initially led us on to believe during Liberation Day. So I think the market is saying, okay, well, he's going to be more, um, he's going to take a different approach, a less hawkish approach, a less draconian approach. And therefore, he's going to be open to pulling back a lot of these policies that we think will be detrimental to the stock market. I'm just talking about looking at this through the lens of the market, right? I'm not saying this is good or bad. And so obviously that's why you see stocks up today. And that's why you see kind of a reversal of everything that we saw during last week's extreme volatility to the downside and then back and forth and back and forth. Now, that doesn't mean that we're out of the woods as far as a bear market, because these are always things that you see. But I think there's lower probabilities that we go into a recession now if guys, and don't make sure you're listening to the next part of what I'm saying here. If the reason we were going into the recession to begin with was strictly as a result of the tariffs. So in other words, if you believe the economy was just humming right along here like this, and all of a sudden we got these tariffs, and it's like, oh my gosh, recession, the economy starts to go down, or the probability of the economy contracting really starts to go up, then yeah, if he pulls back the tariffs, then I think there's a good argument that you avoid that recession. But I don't know that that's true. So our starting point here, if your starting point was not that the economy was humming along here, but if your starting point was that the economy was going downward trajectory like this, and then the tariffs just took it to this trajectory, to that trajectory. Okay, fine. But now that the tariffs have been pulling back, we're still on that trajectory. That's the easiest way that how you like that visual? That's the easiest way that I can describe it. So on that note, let's go over and see what's happening with some more of the consumer sentiment stuff. We talked about the Michigan survey, the University of Michigan survey last week. A lot of people criticize it because it's obviously skews, or there's politics involved there. But the New York Fed survey came out today, maybe a little less political. So let's see what that says. Unemployment fears hit worst levels since cerveza sickness as tariffs fuel inflation outlook. Now, again, this is maybe political, but probably not as political as the University of Michigan survey. And I'm saying that because I saw Zero Hedge even say that this is probably less political. Now, what was funny with Zero Hedge is they're just using that to point out how political the University of Michigan survey is, because all the Democrats are fearing a reacceleration of inflation, which I think is absolutely hilarious because when Zero Hedge isn't knocking the Democrats for their concerns about inflation, they are stoking concerns about inflation and hyperinflation. So I don't know how that works. But anyway, getting back to the article here, key talking points. Consumer worries grew over inflation, unemployment, and stock market. Well, no surprise there. I think the key here is to focus on the unemployment picture because a lot of the soft data, it is true, it's not a great leading indicator. But as Stephanie Pomboy points out in the interview I just had with her on the Rebel Capital's interview channel, is some of the soft data actually does tend to lead the hard data. And the consumer or the average Joe and Jane's sentiment around the labor market, that is one of those soft data points that tends to lead the hard economic data. So key talking point number 2, probability of unemployment rate would be higher a year from now, surged to 44%. This is up 4.6 percentage points and the highest level going back to the cerveza sickness, April 2020. So that in and of itself tells you a lot here. The expectation market will be higher a year from now slid to 33%. Yeah, but I wouldn't really consider that a leading economic indicator. I think that's part of the soft data that I would kind of ignore. In other words, what the average Joe and Jane's, where they think the stock market is going to be next year, I think that's all about just whatever's happened over the last 2 weeks. But again, I think they do have some really good insights on the labor market. So this is the central bank, the New York Fed. This is a survey of consumer expectations. Very similar, it seems, to that University of Michigan survey we talked about last week. So of course, higher cost of living, we get that. That's probably going to skew a little Democrat even in this survey. The survey reflects readings such as University of Michigan, which showed, just as a reminder, the expectations in mid-April, their highest level, our highest since November 1981. I think they're talking about recession probabilities there. The survey reflects other readings, which showed one-year expectations in mid-April at their highest, no, it's got to be a typo, their lowest. The expectations, their lowest since November 1981. In the case of the New York Fed measure, the survey took place ahead of April 2nd, as well as the 90-day suspension. Okay, so we'll have to see how this plays out next month. It could be much, much different. But if it is different, I think it's gonna err to the downside. The next thing I want to point out, guys, is the Market Watch calendar. And going back to last Thursday and Friday when we got the inflation data. Now, as you guys know, I don't think this gives us a good idea as what's actually happened as far as the specific level of consumer price increases. But I think it gives us a good idea as to what the trend is doing. In fact, I did an interview today with Bob Murphy, and he agrees that the CPI probably understates it, but it gives us a good idea of what's happening with the trend. So on the, let's see, I think this is, I wish they would, you have to go to the end to find last week's report. It's kind of annoying. But here we go. So just as a reminder, guys, core CPI, 0.1 on the month, but the main headline CPI went down from 2.8 to 2.4. And the big thing there for me was the month over month decline of 0.1%. And then we look at PPI and we had a month over month decline of 0.4, which the market was expecting a gain of 0.2. So this is producer price is just completely crashing. This is not usually what you would see in an economy that was healthy. I take that back. In a modern economy that was healthy, if we had the economy of the late 1800s, where government spending overall, let's say, was 5% of GDP, then this is actually exactly what I would expect. And it would be a sign of a very, very healthy economy. Why? Because we're producing more stuff. But right now, uh, this is obviously not a sign that we're producing more stuff. It's a sign that demand is going down, and that's always how you tell the good deflation from the bad deflation. Is you just ask the question: is demand increasing or is demand decreasing? Because in good inflation, where we are getting more productive and we're producing more or have access to more goods and services, then you see obviously demand would increase because your unemployment rate probably going down, nominal wages going up. So there's going to be more demand for stuff. And that's the argument on the supply side for the producers that, okay, fine, you're lowering your prices to compete with your competitors, but you're going to be selling a hell of a lot more products. And therefore your profits will likely increase even though your prices are going down. Profits going up in nominal terms. So anyway, but in a unhealthy economy, or one that's not fundamentally sound, where you got a lot of government intervention, malinvestment, misallocation of resources and whatnot, what you see there is when prices are going down, that's telling you that demand is going down. Its demand is going down. And that's what leads you to the conclusion that it's likely an economic contraction or heading for an economic contraction. Okay, now what I'd like to do is go over to, let's go to the yield curve. And let's see, I want to start with the 10-year, 2-year, the 2s and 10s. You guys have seen this many times before, but here's an update. And we go back to, let's just call it 1990. Going back here, it's good. I mean, you see consistencies, but it's tough because the Fed really wasn't targeting interest rates back then. So it would add a far less impact on the 2-year Treasury, although, as you guys know, the 2-year Treasury leads the Fed. It's not vice versa. And let me write that down. Let's get into that next and look at the CME group. So we'll see what the market expectations are for the Fed dropping rates. But before we get there, let's start at 1990, because this is when Greenspan really started to target the overnight rate. And we see what happens. You got the inversion, you get the uninversion, you kind of back and forth here. It gets messy. There's some noise. Nothing's linear. And then when you see this really steepen out, that's typically when you're right before or when you're getting into the recession. You see the exact same thing happen. .com, same thing here with GFC. And you look at where we were at a huge inversion, but then we're getting this noise, but it's starting to get pretty darn steep here. Now let's go over to the 10-year, because part of the reason it got steep is because the 10-year was just ripping because of all this forced selling with the treasury market, with whether it's unwinding the basis trade or whether it's the sovereigns out there selling treasuries because they have to have the dollars, or it also could be entities out there that just want to tell Trump to pound sand, or they don't want their capital in the United States anymore, so they're dumping treasuries. I mean, it's a combination of everything. But what we see is that it could be subsiding here, and this is what we talked about last week at great lengths, that it's not unprecedented during these crazy cycles or these crazy periods of time to see the dollar tank, to see yields skyrocket. But usually when it reverses hard, because it's only temporary, and then it goes back to growth inflation expectations, and then it goes back to kind of as far as the dollar, it goes back to a flight to safety, right? And then with the dollar too, there's a lot of mechanics in there, right, guys? There's a lot of plumbing, and I talked about that with Bob today as well, in that all these dollars were lent into existence. So if one person's selling them, then another person has to have them. So just to make things overly simplistic, in my view, if you do have foreigners that are selling dollars, regardless of whether they're doing it because they want to or they have to, you're going to see whatever we get to when we get to that bottoming on the DXY, and I think that top on yields, you see it kind of snap right back to where it was. But we'll have to see how this plays out. It's I love this because it's really a great test for my hypothesis and my theory around how the global dollar monetary system actually works. And one thing that we've got to focus on here throughout the week, guys, and Snyder's been talking about this, is we've got to focus on emerging markets relative to the dollar, because emerging markets tend to have more dollar denominated debt. So if my theory about the monetary system is correct, then even if we're seeing DXY go down, basically yen euro, then we should see the dollar flat, if not up, against EM currencies, because they've got the vast majority of the dollar denominated debt. So if you guys remember that whiteboard video I did last week, the EMs are the foreigner Fred, and the Eurozone and Japan, they have a lot of dollar debt, but they're more in the foreigner franc camp. So anyway, and then we start to see the 10-year right here down 11 basis points just today. So we're already back down to 4.38. One day isn't a trend, but we'll have to see if kind of things have shaken out as far as that volatility in treasuries, and then we start seeing yields really come down. And the reason I'm going over this is because that would give you another signal that the recession most likely has not been canceled. And then let's get, before we get into what the market is predicting for Fed funds, let's get into, first the dollar. Obviously, that's really important. So dollar at 99.71, pretty much flat for the day, still under 100. 2-year down pretty much the exact same as the 10-year. So let's remember, guys, that Fed funds right now is at 4.33. So 2-year is telling the Fed funds that they're way too high. You're way too high, Jerome Powell. So it would not surprise me if the Fed came out and dropped. I think they meet in like 20 days. I know the probability is against that, but I think that'd probably be a good bet as far as the risk reward. I'm not saying that they'll do it for sure. I'm just saying the risk reward I think is skewed in your favor, because the market is giving a pretty low probability to that. And to be exact, the market right now is giving a rate cut for May 7th at 16.8%. So an 83% chance that they will not cut. And I don't know. I think I might take that bet based on the odds that you gave me. I think that might be a decent bet there. You know what? Josh, can you do me a favor? When do we get the next CPI report? Because that's going to be a big, big deal. If we get the CPI report out prior to May 7th and it is down around 2%, which I think it probably will be if oil stays in the low 60s, if not the 50s, then I think that really increases the probability that the Fed cuts, and you could be able to kind of take advantage of that skew right now. So Josh, can you look that up real quick? Okay, so now let's go back to, let's look at the 10-year 3-month. We looked at the 10-year 2-year. Yeah, you get more noise with the 3-month 10-year, but it's the same thing. Like you see this uninversion, inversion back. You see kind of something similar here prior to the early 90s recession. So this is not uncommon right here, and it seems like that is starting to steepen. Yeah, boy, just slightly, just slightly. Okay, then the last thing that I want to focus on, guys, is the right here. Treasury and agency security. So going back to my theories on how the global monetary system works and why supply of treasuries really isn't that big of a factor. There's a lot of noise, but over the mid run or midterm, the supply really doesn't impact it, because if you have more supply coming on, that's going to drop the price. And if inflation and growth expectations don't change, then that's going to incentivize buyers to come in and hit the bid. And that's going to bring your price right back up. It's going to bring yields right back down. Again, it's kind of this snap back. It's just based on, does it take 2 weeks, 3 weeks, 4 weeks, etc. And so this is really a great chart because it focuses on the commercial banks. So as you guys know from watching my videos, the balance sheet that I think comes in, the buyers that I think come in if yields go up to a certain point, they're mostly banks, because they're not worried about these supply factors. They're simply worried about a spread. So if they're borrowing dollars at 2%, and it makes sense for them to buy at 4%, to pocket that 2% spread. If the spread goes up to 2.5%, that's just gravy. They're just like, hit me, hit me, hit me. And so I thought it was interesting that, I wish they gave us some real-time data here, but this kind of lags. We've got February, we've got March, but you can see the trend is definitely up, with banks actually buying the treasuries and agents, so MBS. And my guess is when we get the data for April, you'll continue to see this trend increase. So as the market overall might be selling treasuries over the last week and a half, my bet is the banks are buying. They're the ones that are actually buying, because for them, growth inflation expectations remain the same, if not are lower, but yet the price of those treasuries that they'd love to have on their balance sheet just got a lot cheaper. But this tells you, going back and coming full circle here, that if they are continuing to buy safe and liquid assets, that this reinforces the idea that even with the tariffs being pulled back a bit, they're still expecting a recession. Now let's go over to how the other markets responded, guys. And obviously, everyone's really interested in gold.
And it was May 13th when CPI comes up.
Shoot, that sucks. So Josh said it's May 13th when the next CPI report comes out. If that was prior to the Fed meeting, I think you could see some fireworks there and the probabilities as far as a rate cut. But you've got to assume the Fed is going to get that data in advance. So I don't know. It's not a prediction. It's not a prediction on that the Fed is going to drop rates. But if you're giving me these odds, I think I might take that bet. I mean, if I had to place the odds, I would be at like probably 60-40. 60-40. I would not be at 80 or 83-16. Okay, so Dow up 300 points today. S&P up 42, so about, okay, so decent day here. But see, VIX is still at 30. That's not a good sign. If this was the start of a new bull market and, the VIX, you would expect to be a lot lower. So what we could be seeing right now is just your typical kind of bubble chart, which, where did that go? Where's my bubble chart? I had it up. There we go. So we could be right here. Maybe not. But if we weren't right here, the odds are that the VIX wouldn't be in the 30s. So that's kind of one of those clues and one of those signals that are beneath the hood that you've got to pay attention to. Okay, so bonds, we talked about that. Bitcoin up, so this would tell me that we're more risk on. That definitely coincides with what we're seeing in the NASDAQ and in the stock market. I'm assuming this is because of the belief that we're going to get less draconian tariffs. Now, gold, whoo, what a run. Let's look at a chart of gold here, because I've been saying this for, man, quite some time, that gold chart looked just awesome. Out of all the charts that I look at, gold looked the best over the last, let's just say, 3 or 4 months. So yeah, look at this. Just, you've got this dip, but then you've got it breaking straight through resistance. And let's see what we've done more recently. Yeah. I mean, you might have a pullback here to call it, yeah, a little under 3,200, but the chart still looks really, really good. So on that note, I'd like to talk about the sponsor that we've had for about a month or so. And I'm really pleased with these guys. I actually set up an account with them. It's Monetary Metals. And what makes Monetary Metals unique is they actually pay you interest for the gold that you have with them in gold. And I think that's really, really cool. That's what attracted me to the deal. And hopefully, I have to sign in again. I was going to show you my, like, kind of the back end that I have with Monetary Metals. But what they do is it's basically leasing to jewelers. So you've got a jeweler that wants to hedge their inventory. And because they don't want to be, the price swings up and down and up and down, and they don't want to be susceptible to that. So they'll go ahead and lease gold. And then what happens is Monetary Metals takes that inventory, that gold inventory, or the jewelry that they actually have. And so then they kind of lock it up, so to speak. And then the jeweler takes the gold, sells it in the market, gets the dollars. And then they're not, I mean, I could go through the whole process on a whiteboard, but then they're not really at risk of market fluctuations. They're not going to take advantage of the upside because they've got to buy that gold back at the end of the expiration, at the end of the contract, let's say in 6 months. But they don't have any of the downside either. And then they're willing to do that and pay the little bit of interest, let's say 3 or 4%, and they're actually willing to pay that in gold. Because that's their business. So that's kind of how it works. But if you've thought about, the store, that is kind of the downside with gold, right? That you've got the storage fees, and especially if you got a lot of it. And so this kind of eliminates the storage fee, but it also gives you the opportunity to actually earn an interest rate and have that gold provide a yield. So now it's like, okay, do you want to buy treasuries at 4%? Or do you want to own gold and get 4% paid in gold? So bottom line is, I've had a great experience with them, and you can check them out at what's our code, Josh? I think it's monetary-metals.com/gammon. So go to monetary-metals.com/gammon. And then you can ask them more questions, and they can explain the business model very thoroughly. But so far, it's been great. I've had an awesome experience, and I can't recommend them enough. And one of the main reasons I accepted them as a sponsor is because I know Keith really well, the owner. And Keith is a sharp guy. I've met him face to face at the New Orleans Investment Conference, and he's someone I trust. So obviously, there's no way I would put my gold with someone that I don't trust, regardless of how neat their business model was. And it's not someone that I would be comfortable bringing onto the channel as a sponsor. So anyway, shoot them an email, give them a call, and their representatives can explain it a lot better than I can. And if it's something you're interested in, check it out. Okay, now getting back to gold here. The chart looks fantastic. Another thing that I was thinking about with gold, though, is you do have that gold-silver ratio. And I know that silver, based on that ratio, is extremely undervalued, underpriced. So I don't know. I haven't done a lot of research as far as, how precise that silver to gold ratio is. But if you're someone that's really into that, and if you think the gold chart looks great, you might want to consider looking at silver. It's not investment advice. I'm just kind of pointing out the look at this. See, this chart does not look good. This chart does not look good. So personally, I would not buy silver here because I don't like this. And it seems to me that this chart is screaming recession because of the industrial component with silver. But like I said, if you're someone that really believes in that ratio and you believe that gold is going to continue to go higher, usually when you get that ratio that mean reverts, that means gold or silver, excuse me, just absolutely rips, just rips higher. And on this, I'm very curious what copper is doing. Let's look at a copper chart, guys, because that's going to give us some more insights as to what might be happening with silver. Yeah. See, that's what's happening, guys. Yeah. It's the recession probability is dragging on silver. That's basically the reason the ratio or the spread is so big with the gold price and the silver price based on its historic average is because the silver is just being dragged down by that recession probability, where in all likelihood the gold is probably being propped up by that recession probability, because that recession probability comes with uncertainty. And I think that's what really, at the end of the day, moves gold in the short run. All right, guys, on that note, let's do some Q&A over at Rumble. I think that's been going extremely well. So if you're on YouTube right now, if you're on Twitter, go ahead and shoot over to Rumble. Josh, do me a favor and put the link up in the description, please. And so people can just click that link and go over there to Rumble and ask their question. And perfect. There it is. So we're going to go ahead and remove the stream for YouTube and for Twitter. Guys, like I said, shoot over to X, ask a question. I'll be over there for at least 15 minutes doing my best to answer as many of your questions as I possibly can. And when you're over on Rumble, do me a favor, make sure you subscribe. We've had a lot of, let's just say, issues with YouTube. I don't know how much longer they're going to allow these channels to be up. So just as a safety net or precaution, let's start focusing on Rumble. So as always, if you're on YouTube and Twitter, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you on the next video, and we'll see you over on the Rumble Q&A.